prices will soon normalize. Fred Squire has more on the economic outlook for Europeans. The scorecard for the U.S. economy is the gross domestic product, or GDP. New numbers out today show the economy grew in the third quarter. Is this a sign a recession may be averted? I've asked my next guest, Ed Siddell, CEO and Chief Investment Advisor at EGSI Financial. Ed, good to have you. Thanks for being here.
Yeah, thanks for having me back.
So the headline is GDP grew 2.9% in the third quarter. But let's dig a little deeper, shall we? What can you tell us about the underlying details?
Yeah, from the surface, the numbers look pretty good, right? Because the consensus was supposed to be 2.7, the range was 2.6 to 3.2, and it was right in the middle at 2.9. But when you really look into it, why was the GDP actually positive? Personally, I believe it's two factors. Number one, the strength of the dollar, the U.S. dollar against all other world currencies, because that means, all imports are a lot cheaper. The other factor is the strategic petroleum reserve. As we're exporting that oil, what that does is it shrinks the trade deficit. So it actually looks like we're expanding our economy instead of shrinking it. Because as soon as you remove those two things, it's actually flat. It really didn't gain any momentum.
Yeah, see, the details matter. So what does this mean in terms of a recession?
Personally, I think we're in it right now. What we're seeing, even today with the market being up, it's really just a bear market rally. All the companies, they're reducing their labor forces. Everyone's starting to kind of hunker down a little bit. You've got discretionary spending that's down. Prices are going up, and as the dollar continues to weaken, so it's way down off of its highs. It's down about 8% off of the highs so far. It's still up 10% for the year, but as the dollar weakens, those imports are going to get more and more expensive, and so people are struggling right now. I mean, the Fed's already said that debt is at an all-time high at $16.5 trillion, and from last year to this year, we added $1.27 trillion in consumer debt. So how are people going to continue to not only live, but service that debt as well? So I think winter is coming. And I'm not just talking about the season.
Well, we just saw Black Friday, Cyber Monday. Numbers show that consumers, they were still spending. They spent pretty big. But the Case-Shiller report out yesterday shows the housing market still struggling because of the high interest rates. So what do you attribute the GDP growth to? Is there anything else you're looking at?
No, again, I think the numbers are misleading. People are buying, but they're putting it on credit. So again, that adding 1.27 trillion, I mean, that's the largest increase adjusted for inflation, in over 20 years. So at some point in time, as prices continue to increase, that discretionary spending is just going to stop. And so I think going into next year, it's going to be very, very tough. I think probably the first quarter, as far as the markets go, it's going to be very, very difficult. We may even see new lows. But I think at the end of the year, we could wind up positive as far as the markets go. But the economy is going to be a struggle.
All right. Ed Siddell, CEO, Chief Investment Advisor at EGSI Financial. Thanks for your time today. Appreciate it.
Thank you.
Still to come here on OAN